YouTube? EBS Invest here, bringing you guys a brand new video. Today we'll be discussing Alphabet, or known in the streets as Google. The ticker for this company, there's actually two, believe it or not, is GOOGL or GOOG. So the only difference is the L at the end. The GOOGL or Google is a Class A share, so that one gets voting rights. So if you wanted to vote in a referendum that Alphabet offers, you can. GOOG is a Class C share, and that one does not get voting rights. So it's up to you if you want the voting rights or not. Generally, Google does trade at a slight premium compared to its counterpart. So you can see right now we're trading at 121.68, and I think, oh, Google is actually trading at a little bit more. So you can see there's like a dollar difference. It's not really going to like affect the world, like the world's not going to end about it. But it's up to you if you want the voting rights or not. But Alphabet is a conglomerate holding company, so they own Google, YouTube, Google Vehicles, DeepMind, Wing, and much more. So it's kind of like Meta. You know how Meta owns Facebook, Instagram, things like that. Alphabet is the third largest holding in the S&P 500 and one of the world's biggest companies, and it is the third largest tech revenue um, in the industry. But it isn't all sunshines and rainbows for Alphabet because they're always getting sued for monopoly issues over their search engine being prioritized on Android phones and operating systems, tracking their customers without their consent, and unlawful monitoring of their employees. In general, they don't have the best privacy policy. If you look it up, they literally sell your data, and there's nothing you can do about it, which is why I don't even use Google as a browser. I use DuckDuckGo through Firefox. But you can see here, looking at the stock, this is the Class C share. We got to go back to the Class A. I think the C share came out later. But you can see Class A IPO'd in 2004 is up 4,300% since its IPO. And overall, they give Google a grade of A minus. This is a great company. You can see there's not really much cycles in it. You can see it's always generally gone up, and it kind of looks like the S&P 500 if you look at it a little bit. But now we're going to go over and we're going to evaluate the stock from the Track Your Dividends page, and we'll go a little bit more in depth into this company. So coming over to the Track Your Dividends page, you can see they give them a score of 15. It's kind of irrelevant because Google, I'm just going to call it Google from now on, guys. I'm not going to call it Alphabet. Google pays $0 for the dividend. They don't even have a dividend. So it's really up to you. But if you're a hardcore dividend investor and like all your stocks need to be dividends, then this is not a stock for you. But I believe that sometimes you have to sacrifice that dividend in order to get growth. Okay, like sure, like this company pays no dividend, but it's still growing. Google is growing its revenue. We'll see later on, and they're growing it very well. And I truly think that sometimes you have to sacrifice that dividend to achieve a little bit more growth, but it also just depends on your lifestyle and where your portfolio is at. Coming down here, that you can see that Google has a market cap of $1.9 trillion and has a PE ratio of 27.9, excuse me. You may be wondering what even is a PE ratio. So that means price to earnings. So that means that you have to pay $27.9 to receive $1 back, hypothetically. So that's how much you have to invest. Generally, the higher the PE, the more growth that they're expecting. The lower the PE, less growth. Sometimes there are companies that are just growing phenomenally and their PE is just not really doing much. Sometimes. Now we're gonna go over to the charts page now, and we're gonna analyze the company. So you can see they were going pretty well here, a little bit of stagnation, and then obviously this was the COVID bubble. But now you can see that they have a net margin of 30%. They have 35% profit before taxes, so it's actually really good profit margin, and it looks to be really solid, and it looks to be that they're growing it. At least that's what I can tell from this graph here. Going over to the capital allocation, you can see that the return on equity was up and then came down, and now it's just really shot up, especially during the COVID bubble. So that could be something that would concern me. As you can see, if we take out the 2021 and if we just focus everything after that, it hasn't really been growing that much. So 2021 was really big year. So you might need to do a little bit more research into why. Going over to their sales and earnings, you can see this could actually be an explanation here, is because look at that big, they brought in a bunch of money in revenue that year. So that could be a reason why they had so much return on equity, but I'm not exactly sure. But you can see that they've been growing their sales very well as their earnings. So very nice bar graphs there. Going over to their cash flow, almost identical to their sales and earnings here, growing very steadily. You can see that they're increasing that free cash, which is very good to see. Besides in 2018, not sure what happened there. Going over to their sales, it looks to be that they did fine. So you might want to look into 2018 why they had a little less cash flow. They might have acquired a company in 2018. They have increased their debt, but their current ratio is down. I wouldn't worry too much about their debt, guys, because this is a AA rated bond company. So they have the ability to pay back their debt really well. They can take on debt really well. Shout out to my friend Turtle, Mr. Income, if you're watching this. I got that from you guys. But they're a AA rated company. That's exceptional. There's not very many companies that even get in the A grade. So I think I wouldn't worry so much about their debt, especially for a company that's this massive. So we're going to head over to the competitor analysis now, and you can see Google ranks down here. That's just because they don't pay a dividend. I would say Google, if they were to pay a dividend, would probably be near the Microsoft dot. Their dividend would be a little bit lower, so it might be somewhere around here-ish. But I'd say that Google is one of the better companies, especially comparing it to some of these others. So, but like I said, depends on your portfolio if you want the dividend or not. Now we're going to go over to the valuation page, and you can see that they give Google a value of $208. So I do think that they are a little bullish on this software. So we'll go over to my sheet and we'll grade it there. But you can see that they score Google a 5 on their cash flow, 5 on their equity, and 5 on their price to book, and they get 3s on everywhere else. So that gets a grade of a 4 if you average it out. So that means that they're about a B company in terms of their ratios. I'm not saying they're a B company overall, but their ratios look to be about B, B plus. But it is good to see that their cash flow is doing pretty well. You can see if their metrics, like we said, got a $208 value here, and they say it's undervalued by 41%. I'm going to go over to my sheet and we'll check it out. All right, so we're on my sheet here, and we're going to just put in the ticker GOGL. And all we need to do is you need to go to Yahoo Finance. Yahoo Finance. Everyone loves Yahoo Finance. And then all you have to do is you look up the company, Google, and then you go to the analysis page, and you scroll down, and you find the growth. So they say that in the next year, Google is supposed to grow at 15.6%, and in the next 5 years, 13.6%. So I would say that's an average of 14, and I like to take 5 off that number. So let's just throw in a 9. And then one thing that I'm also going to do is I'm going to increase to 2, and then I'm going to increase to 0.8. Why am I increasing those numbers so much to be bullish? I truly think that Google has a great moat, so this company is going to be very hard to replicate. Okay, there's not going to be another Google search engine that just takes over the world in 85% of the market space, right? Google's a $2 trillion company. So I'm giving it a little bit more bullish numbers here because it's hard to replicate. It has a good moat. You know, people aren't able to replicate Google. They can try, but they're going to fail. So you can see with those assumptions here, you can see that we get an intrinsic value of 153. Going back over here, we take that $208 number and we chuck it in here. So you can see that we get a total of 180. That's our blended average, and we get a buy price of 144. So as it currently stands, because Google is trading at $121, Google is definitely a buy. If you believe in Google as well as their ability to grow at that 9% like we talked about, even if Google only grows at, let's say, 7%, there still is room at $168 and $135. I think Google has great plays. They have their cloud space, which is growing pretty well, and they also have their quantum computing space. That one's a little bit farther off in the future, but if you believe in quantum computing, Google is one of the leaders in there with IBM. So, as it currently stands, this is not financial advice. I would say Google is a buy, but remember, if you want that dividend, this is not a company for you. But if you're willing to sacrifice that dividend, definitely pick up some Google. Thanks for watching, guys. This has been EBS Invest. Please subscribe and like for more content. Also, drop a follow for any suggestions for any future stock analysis that you guys want. Thanks for watching. This has been EBS Invest. See ya. Peace.